Well, good afternoon, everyone. We're glad that you could join us, whether you're watching live or catch this part of a pre-recorded later. We welcome you to our plan series webinar for this month. We have an interesting topic. We're going to be discussing alternative investments. So by the name alternative, you might be wondering where this fits in with you personally. So we'll get into that. Rest assured, alternative investments, you've probably seen them in some way, shape, or form in your portfolio. Over time, they're just not as mainstream as perhaps some of the other investments that you're used to. So we'll get into that in a moment, but I wanted to mention that at the onset. Why it's important is we're going to discuss this this month. These are some difficult investing climates with high inflation and low yields, where alternative investments have been put back in the spotlight as an alternative to some of the mainstream investments that we see. Just as a reminder as well, feel free to use the chat feature in our program today. We keep our videos and audios off as we're recording this, but if you have some questions, please use the chat feature. We'll try to address these as they come up, if not at the end of the program. Also, as I mentioned, this will be pre-recorded. We'll send a link out afterwards on our website. So if you enjoy it, feel free to send it out to friends and family. Okay, so let's get into our program today. Alternative investments. Here's a bit of our topics for today. So first off, we're going to get a general understanding of alternative investments. What types of alternative investments? It's a wide category that seems to have thrown in several different types into this broad category of alternatives. So we're going to dissect that a bit, get a little understanding of what alternative investments are. Then we're going to spend some time talking about the pros and cons of each of those tranches, the different types of alternatives, and honing in on where they may be appropriate in your portfolios. And lastly, really the most important, what we want to know is, are they for you? Where do they fit in? So let's get into that first area here of the different types. So you see 6 different mentioned there in the main part of our slide. So I'm just going to run through those real quick. The general tranches, areas of alternative investments, are broadly categorized as private equity, venture capital, hedge funds, private debts, real estate, and commodities. But let's kind of back up just a bit how those come about. These are available as what the regulators define as through accredited or non-accredited investors. So that's kind of the first differentiator, for these is this difference, accredited versus non-accredited. Well, what is that? Well, regulators define accredited investors as ones who make over $200,000 individually or $300,000 a year joint income, as well as have an individual net worth exceeding $1 million. So if you qualify for one or both of those, then you're, as the regulators define, as an accredited investor. For those who don't meet one or both of those standards, fit into the category of non-accredited investors, where 99% of all investors lie, where the investment products that we know and love are made most widely available to. So talking about these and how they fit in, it's good to know those definitions, as we'll bring up those terminologies a little bit later. Because not all of these just apply to accredited or to non-accredited. There's a bit of a blend in each of these tranches that are available. So it's helpful for us to know those different accessibilities. So let's first talk about these first couple on our list here: private equity, venture capital, and we can kind of cross those off our list pretty early as not one that we often see in building retirement portfolios too often. Now, private equity, venture capital, you've probably seen these on the news or seen them in movies. And, private equity, venture capital, these are non-publicly traded companies. These are early stage type companies. Most of the big companies that we've seen all at some point started as just little infants, and that's where these private equity and venture capital deals come into play. Large amounts of money to seed and start companies, but it takes a long time for the payback. So we can kind of cross those off. Typically not something that we would see, especially in retirement portfolios or mainstream type investors, because really the large amount of initial investment and the long period of time before payback. But like with anything else in investing, the risk versus return, if you're willing to take the risk, there's potential for very high returns. Now there's hedge funds as well. Now there's all kinds of different hedge funds. There's actually 16 common types of hedge fund strategies, from super high risk to some that aren't. One common strategy is what's called a long short strategy, which is designed to capture as much of the upside as possible, but does its best using shorting investments and other options to minimize downside. So its strategy really is to reduce risk. So again, we've got quite a bit of a moat there with that space and alternative investments, hedge funds, from that very high risk to some that can be its objective to really minimize risk in the portfolio. But again, accessibility often only available to accredited investors. Now, next, we're going to get into this private debt. Seems like this is pretty straightforward, but many of you own bonds or bond mutual funds and ETFs. Those are public debt, publicly traded companies, governments, etc., that issue debt to fund operations. Private debt, very similar in its structure, but obviously these are private companies, private lenders. So in this particular case, because not being a publicly traded company and its disclosure, oftentimes investors can achieve higher yields than they can in the public markets. But again, accessibility is difficult, often only available to accredited investors, but in recent years, there has been increased availability to non-accredited investors. And we can talk about that in a little bit. Now, the last two are probably the most common, and maybe what you've already seen in some of your portfolios over the years, is real estate and commodities. Now, if you don't want to be a landlord, there's products all over for such. They're also considered an alternative investment class. Investors who don't want to be landlords can buy what's called REITs, R-E-I-T, real estate investment trusts. Now, those can be both private and public, and some of these as well can be packaged up and bought through different funds like ETFs and open-ended mutual funds as well. So depending on what type, you could have access both as an accredited or a non-accredited investor, depending what type of REIT that you're buying. And there's many publicly traded REITs that trade on exchanges each day. There are mutual funds and ETFs that you can buy as well that purchase and focus in on specific sectors and types of real estate as well. So accessibility here is available to both accredited and non-accredited investors. And lastly, commodities. And this, we're familiar with these. We've got oil, we've got gold, we've got silver, copper, etc. These mere real assets. And oftentimes these are done through these open-ended products such as mutual funds and ETFs, etc. You can buy those. Very few people actually hedge against inflation by buying barrels of oil, put them in your backyard, or bars of gold. So oftentimes these are done through investment products such as mutual funds and ETFs. And from time to time, you've probably seen these as well in your portfolio. Again, accessibility, often widely available to non-accredited investors, but again, considered into that area of alternative investments. That's a brief rundown there, and we're going to spend most of our time what is most applicable to investors that we work with. But just wanted to give you some context of what an alternative investment is, as we might have been thinking that these would be for the Rockefellers, et cetera. Okay, so now let's talk first about, as we just mentioned, as we conclude, is we're going to just kind of focus on the non-highlighted areas, when we want to think about how this fits into your portfolio. We generally, as a firm, we shy away from these highlighted areas, especially the darker ones, the venture capital, the private equity, even the hedge funds, because of their limited access to accredited investors. However, real estate and commodities have evolved and have access to mainstream investors, and with the right discipline, these can be added to the portfolio and to enhance returns. So let's first talk about the pros and cons before we talk about exactly where they do fit into the portfolio. Pros and cons, jotted down a few here for each to consider. I'm going to mention them just here in order. Some of the pros is the diversification, the uniqueness, and the enhanced returns. Some of the cons are the limited regulation, complexity, and access. We've already touched upon a couple of those. We'll build upon that here in a moment, though. So let's circle back with the pros. What do we mean? Diversification as a pro, using alternative investments in the portfolio. Well, as many of you have noticed, that when the stock market goes down, most of the closely related other stock sectors, they follow suit. It's like a river that's raging, and you might picture a dam. That the dam has now been released, and this huge tidal wave coming through and flooding the rivers, and anything that seemingly had firm footing is being swept away. And that's likened to many stock market corrections, as we know that different asset classes over time can produce different returns. Under normal market conditions, may not act exactly the same way. However, when we see large corrections, short-term corrections, panic selling, et cetera, or even the opposite, when the markets are going gangbusters because of euphoria, that's called correlation. When things are tied together, kind of flowing all the same direction, correlation. Now, alternatives can provide diversification by adding into asset classes that aren't always heavily correlated to stock market activity. For example, we mentioned earlier about commodities, buying gold, buying oil. They each have their own risks that move the value of each of those underlying commodities. Real estate, and oftentimes real estate can be viewed as going up and positive economic conditions. However, so we've seen in recent years, they can be uncorrelated as well. Real estate prices could be going down where the economy is going up, and vice versa. So again, these alternative investment classes can often be viewed as uncorrelated or even negatively correlated to the market. So this can provide some diversification. Next is the uniqueness of it, as with these types of investments, they're not as widely available. And not being widely available, there could be some inefficiencies. And these inefficiencies can produce returns, big payouts. So in many of these as well, there's a time factor that for them to develop. For example, real estate, some real estate investment trusts, if you're buying non-publicly traded, could have a maturity, 5, 7, 10 years. So patience too is another reward when it comes to investing. And lastly, another pro is the enhanced returns And with alternative investing, as mentioned, the ability for large payouts exists. We often stay away from some of those very risky sectors. However, some alternatives, because of diversification and asset allocation being that actually accounts for over 90% of portfolio return. Just having diversification, increased diversification, does enhance returns. However, often the ability with alternative investments as well is its ability to protect on the downside. So in the long run, that too can enhance overall returns because of short selling options, leverage, economies of scale, etc. This can produce enhanced returns. Now, some of the cons, though, of alternative investments is its limited regulation. Alternative investments, when they're not publicly traded markets, they can be a little bit harder to find and research. Now, just stepping back, most publicly traded investments, but almost all that you have invested in, fall under the 1940 Investment Act. So that's very common in my world, the 1940 Investment Act, which regulates all investment funds, mutual funds, closed-end funds, ETFs, etc. It's also defined in the beginning that accredited and non-accredited investor is, private placements, etc. So in that particular, though, that small section that in that 1940 Act that's devoted to alternative investments like this is the disclosures in this is just not as robust as the mainstream investments. So because of that, we're going to chalk that up as a potential con. Many of us have seen a large mutual fund perspective, quite a bit of regulation and disclosure needed. Some of these more private deals on alternative investments, the disclosures just aren't as robust. With that, lower regulation also comes another con, complexity. These can be very complex, especially if you're dealing with venture capital and those riskier types of investments. Getting research, doing your due diligence can be extremely time consuming. And really the reward from that, the difference between some of the top quartile hedge fund managers in the bottom is huge, much huger, bigger than if you were comparing the best large cap mutual fund manager versus the worst large cap mutual fund investor. The moat isn't as deep between those two as often you'll see in successful alternative investment managers versus those who don't fare as well. And last one is access, as we just mentioned a moment ago. Access with these one have lockout periods, and of course with the accredited versus non-accredited, and the liquidity factor. So some of these need to be finessed if we're going to be looking at those as making up a part of retirement portfolios today. So just wanted to jot down a few of these to consider, some of these pros and cons. And where do they fit then? Where do they fit into real investors such as you and I and the portfolios? Well, in recent years, there's been many more opportunities for non-accredited investors to invest in alternatives investments. In fact, an ETF is only 10, 15 years old, this product. So that has opened the door quite a bit for investors to invest in an alternative sector like investments as commodities and real estate, etc. Other access like closed-end funds have been made available that can package up these types of investments and put them into products that are heavily regulated that we can purchase and put into portfolios as well. So the point of this is in recent years, the evolution of the financial marketplace, there's been more and more opportunities because of regulation for non-accredited investors to invest in some of these alternative investment classes. But more mainstream ones, as we just mentioned prior, real estate and commodities. Why would you buy those? What's its point? Well, the purpose of real estate and you can focus in or be broad with just general real estate, or focus in on, say, you want to buy healthcare, hospitals, right? You want to focus in on that sector, or perhaps you want to focus in on residential real estate or malls, et cetera. So you can focus. You can be broad in your scope. You can go international with your real estate. But just like with all real estate investors, you're looking for that return, not just the capital appreciation of the real estate, but there's that income feature. People are paying rent. And similar to a bond, that's the goal, is that there's some interest yield that accrues because of that. So with real estate, we invest in real estate because of that. Typically higher yields than your normal bonds. And as mentioned in the onset, because of high inflation, low interest rates, looking for a yield, real estate today has become a favorable approach. Commodities, another mainstream alternative investment that we can see and use in retirement portfolios or just in everyday investments. This is because many investors look to hard assets in times of high inflation, and we're certainly in that period of time as well. And the accessibility of those has made it available for investors such as you and I to invest in. Now, thinking about some of the access, there has been some increased access. We mentioned private debt, much like public debt, but is private in nature, was typically in the last, up until the last maybe 3 to 5 years, only available to accredited investors. However, because of evolution in financial instruments, these same types of private debt deals, the minimums have been reduced and available because of regulation to non-accredited investors. So many today can also start to play into that space as well. Once again, with higher yields typically than your run-of-the-mill bond. So purchasing those through, for example, what we see as an evolution in financial instruments is drove down the amount of investment, which is one big reason what prevented many from getting into these in the past is the amount of that minimum investment. So REITs, you can get through mutual funds and ETFs, just like any other, a minimum $1,000, $5,000 to get into some of these. And non-publicly traded REITs, if you went right to the REIT, then maybe as low as 25,000 to get into that. And that's come down quite a bit over the last several decades. Private debt, as we mentioned, a newer instrument. Those can be similarly in the 25 to 50,000 versus years past where you needed to bring in $1 million just in that one category. So that evolution has drove down that barrier, the minimum investment needed to participate. And because of greater regulation, has really opened the door for access for mainstream investors such as you and I. But really, where does this fit in? Alternatives are still alternatives. And we generally recommend allocating less than 10 to 15% of your total net worth because of there's still that inherent risk with these. They serve a purpose. Often they're focused on current market conditions. It's purpose like commodities and real estate, et cetera. Sometimes they're very purposed and just for specific periods of time and market activity. But still allocating a small part of the portfolio can enhance returns, provide greater diversification for the portfolio. So just to wrap up, those different tranches of alternative investment seems to be a very big hole that they've thrown in quite a bit of very different investment vehicles. But for mainstream investors such as you and I, access to real estate, commodities, even private debt has made it available to mainstream investors where we can enhance returns, increase diversification. So feel free to throw in any of your questions into our chat here this afternoon, can address those as needed. But of course, we want to thank you for taking the time today. We want to stick to our commitment to keeping it at under 30 minutes. So I thank you for your attention. Hopefully you found this to be beneficial and instructive. And of course, to see where it fits into your personal situation, I encourage you to email me or Chris, and we can set up a time to meet and discuss where this may fit into your personal situation. I'd like to also invite you back next time, as we'll be discussing fundamentals of investing. So we're going to go back to the mainstream type of investments. So we went from alternatives, we're going to go to our normal stocks and bonds and mutual funds discussion for next month. So hope you can join us there as well. But thank you again for your time, and look forward to seeing you all again very soon.